All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I'm jumping on a little early here this afternoon, and if something changes dramatically later on today, I'll jump back on. But want to go out and take a look at some of these stocks that have made statements this week. And I know that's a difficult thing for a lot of for a lot of stocks to kind of go out and say, well, this stock made a statement, because most stocks have done what the market has done, and that is the norm. Right, that is the norm, and we see that. And we'll take a look at some examples, but want to go show the ones that are talking a little different here this week. We have not had a lot of weeks in the market over the last several years that have created some watch list differentiation, so it's nice to see. Want to make sure we're capitalizing on it in terms of discussing it. And then it will be capitalized on from a trade perspective when challenge signals come in. Now, speaking of the challenge is in all cash right now. Alibaba is not something I'm going to re-enter here today. It does have a good chance of triggering bearish here this afternoon. That said, the option prices are more ridiculous now than they were yesterday. And I can't justify getting into it. Even if it is a downside signal, I cannot justify getting into it based on the option pricing. It is just simply one where if we wake up and tomorrow, Monday morning, Alibaba's trading at 207, and equities are fairly flat and lose some of the bigger swings, we can see the option go down 50% in a blink of an eye. It's just not a position I want to be in, not what the challenge is designed to be in. So we have potential to see signals out of Apple, Baba, Micron, in AT&T, and I went out and priced the options out on every single one of them, and they're just not tradable. So unless something really dramatic changes here this afternoon, I won't be getting into anything going into the weekend. Now, Michelle forwarded over me a question that I think is very relevant and very valid, and I want to speak to it here for just about a minute. But the question had to do with, hey, Jeff, the challenge, is there something the algorithm can do to handle these types of environments in the market so that we have a lot more trades during this type of environment? And very valid, very, very good question. And the bottom line comes to this. When building the challenge algorithm, we had to build the challenge algorithm with what was the norm for the market. Because to go out and try to build a high probability system for every market condition, every market variable, flat markets, trending markets, small chop markets, big drops and big pops, to create something different for each style of market is one thing. To then identify which style is a whole nother thing. And then to identify what style the market's going to switch into is a whole nother thing. So we really took the market component out of the challenge algorithm. There's no market vibe component in it. There's no SPY component in it. It really is something that is very stock specific, and we did that on purpose. Now, we also knew from testing it over 3 years that there would be times when we would go through dry spells from a signal standpoint. And those can happen for a number of reasons. They can happen in another number of time periods. One reason would be earnings, and not so much that we're not going to have a lot of signals. It's we're not going to have a lot of tradable signals because of option pricing. And we said, okay, that comes 4 times a year. We'll deal with that. We can expand the watch list to a point where we still can trade and still be effective. And yeah, sometimes it's going to be a little, it's going to be a little more annoying than other times, but overall, that's not something we can really get away with, and we're not really trying to predict earnings as is that it's just simply a guessing game, a gambler's game when it comes to options. So great, we know that's there. Fine. How do we deal with it? We don't. We basically say, all right, signal happens. If the option price is insane, we won't get in. The option prices are insane around earnings. We know that, so it keeps us out of earnings. Will we play some earnings as the challenge gets over 10 grand? Yeah, from time to time, and that's fine, and we'll have that leeway, that liberty to do so. The second situation where we don't see many signals is a very flat market, one where there's almost no movement. And, those have happened quite a bit over the last several years, and they tend to last 2 to 3 weeks. And we said, okay, what do we want to do in these periods? And overall, we just decided we're going to run with the challenge as is, and the challenge algorithm, because we still have a chance to grab individual stocks and to ride some trend, but the probability of a trend emerging in that stock is limited during those time periods. Okay, not that big a deal. It's not going to affect the risk factor all that much, but could have a significant effect on the reward factor. Okay, great. And then last is, okay, what do we do when the market goes haywire? Now, haywire, what do I mean? Haywire is the term I'm going to use for what this market is right now. Big pops, big drops, intraday, option pricing, insane. What do we do with it? And when we looked at periods of time, and we had to do a little bit of more eyeball testing than real-time testing to go back into 2012 and 2011 and 2010, 2007, 8, and look and go, okay, how would this all work through those periods of time? And what we found is that we don't really get a lot of signals during those times. We do get some. The accuracy of them isn't any all that different for the most part, but the risk factor tends to be higher. Reward factor can be less depending on the direction we're playing and how overvalued the options are. Because if we're playing calls, you take a big hit in implied volatility value, even though the stock goes your way. So we looked at that and said, okay, how are we going to deal with these types of time periods? We're going to just run with the algorithm as is. And it's one of those where, yeah, it means maybe a few less trades. You could argue, you could make a very valid argument and say, hey, Jeff, had you, and again, this is some hindsight, but this is hindsight that I think has value. Had you held on to Halliburton, right? Remember for the challenge, we had a nice bearish signal on Halliburton. We got in. We ended up pulling an $800, almost an $800 gain on it in a matter of what? In a matter of 1 day there, because we had on the weekend. But had you held it and played it exactly with the challenge parameters, the challenge would have stacked on about 9 to 12 grand in gains just on this trade alone. And you'd have a very valid argument. I didn't do it. I took it off on this day. I got a little skittish with all the risk factors and with what was going on out there in the market. Took a loss on JP Morgan, used the double to just kind of go to cash. And I remember on that day even talking and saying, look, when I've done this before, the couple times where we've just gone to cash, it hasn't been the most monetized scenario. Okay, great. JP Morgan, had we held it, would have gone to zero, but Halliburton would have more than made up for it. And if we would have just followed it with the challenge parameters and peeled off 40% every time it moved 2 average true ranges, it would be a very big gain. And we'd still be in it, okay, had we run it completely. And so you can make that argument. And so I look at this challenge and I say, okay, great. Missed that opportunity, sure. All right, fine. Well, I made a similar decision with Alibaba to be conservative, and that just the way I've operated it when the challenge has been below 10 grand, and I'll continue to do it. I'll continue to be a little bit more on the conservative side than aggressive side. So, bottom line, the challenge and the challenge algorithm in trades are meant to find stocks that come into the more predictable positions. That differs immensely from looking and saying, well, what's going to happen next with this stock? There's two modes of thinking out there for traders. Many traders are in that mode. What's going to happen next? They pull up a stock and they pull up a chart and they think that they should be able to sit down and take this stock and go, what is going to happen next? And they apply all sorts of indicators and all sorts of stuff to it. I say, what's going to happen next with this stock? Sometimes they're right, sometimes they're wrong. But in my experience, those types of traders, their win-loss ratio is nothing very good. And if they apply options to that type of methodology, they tend to lose money over time. The option traders that are successful are the ones that say, look, when does my stock do what I'm looking for it to do? Because when it does what I want it to do, then I know the probabilities are in my favor. And that's what the challenge is built on. It's built on that mentality. So, great. Whatever the market condition is, fine. I need a stock to do what I want it to do, or in this case, what the algorithm is looking for it to do in order to create a trigger. And at that time, then I will go after it. So that's the challenge mentality. There will be times where there will be a lot of signals. There will be times where there will be fewer signals, and we'll go through that, ebb and flow. And it's always one of those when there are few signals. I get some pushback saying, why don't we have more signals? And when there's more signals, I get a pushback, why don't we trade more signals? And I get those, and I understand the mentality, and it's why even the signals that we don't trade, I do post to the spreadsheet. So if you want to go trade them, you can. But applying signals then to a challenge methodology is a whole nother step forward. If we wanted to just go stock signals and just stock trading with stock signals, we could do some pretty fun stuff with the algorithm. But we want to apply it to options, to a challenge, which is another very kind of fun aspect. It's a whole different ballgame of work, of understanding of probabilities, and of understanding of which trades are fitting in, here to the challenge methodology, and which ones put it at risk to take a hit or to take a ding that will put it out of the game. And anyway, that's the idea there, and kind of my 1 minute response that lasted 7 minutes, somewhere around there. So anyway, hopefully that answers it. Now, during these types of time periods in the market, we do get some differentiation that happens in stocks, and it doesn't feel like it because most days you see the market down big, everything's down. Market up big, everything's up. And then you see days like yesterday where the market's down 100 points and Alibaba's trading in the green most of the time. And people tend to think, well, you know what, it's up today on a big red day. That means this stock's going to go higher. And then we have today where, it ends up being a big laggard. What stocks do on a day-to-day basis doesn't mean a heck of a whole lot. To look at stocks and say, well, this one's outperforming today, it can be a very isolated incident. But when we look over a longer period of time, through these very choppy periods, we tend to notice something different. Let's take a look at Oracle. Oracle is an example of about 60% of the stocks out there and what they've done during this time period. About 60% of the charts, this is what you're going to find here from the middle of February to where we are today. Yeah, though some will have a little bit more of a gain and then a little bigger loss, or a little bigger loss, a little more of a bounce back. But overall, their net result is they are very close, if not at their lows, and had a pretty fierce bounce earlier this week that has been completely erased. 60% of the charts. This is what they look like. And, we can go out and take a look at American Airlines. That's what it looks like. We can take a look at Disney. That's what it looks like. They're the same chart. Then we have about 20% of the charts that look like Apple, where they had a sharp drop, a nice little recovery, but didn't come back up to where they were before the sharp drop and are starting to pull back. But they're not setting lower lows. At least not yet. They still could. Apple could be one day away from a lower low. But so far, they're not setting lower lows. We have about 20% of the challenge watch list that look like this, that have this image here to them. Then we have about 10% of the challenge watch list that has a different look. AT&T. Why do I say different? Well, I say different because starts the drop, okay? Has the big drop with everything else last week, and then this week's rally took it back to where it was when the drop started. The rebound on AT&T was more than a retracement. It was a full rebound for just a moment. Now, naturally, it's pulled on back the last 2 days as the market has, but you'll notice it's nowhere close to setting a lower low, and it is something where it still hasn't even pulled back into the retracement areas of the rally. It's holding up extremely well. What's the idea behind these stocks? The idea behind these stocks is that after the mayhem, after the pullback, after all the confusion and the volatility and all the guessing work that is being done in this type of environment that tends to last 3 to 6 weeks, after that, these types of stocks, they tend to go to new highs and keep going. What does that tell me? That tells me that right now with AT&T, I can go get in fine, but I'm not going to have any expectations that it can't drop. And if it pops, great, fine. I could get into the minutia of of all the popping and dropping right now. But I can also wait for the market to stabilize, and we'll see that. We'll see where the market starts to have a lower range on it each and every day. It's not trading in a 3% range anymore. It's down to a 0.5% range. And when the market does that, stocks like AT&T have a much higher potential of hitting a new high and then keep on going. Only about 10% of the watch list look like this. Let's take a look at the stocks. AT&T. Home Depot did this. Here we are with Home Depot. Home Depot had the initial drop day right here, then had that earnings gap up. But this rally this week brought it almost back to the highs in a very AT&T style fashion. Now, it's pulled back the last 2 days. Yep, of course. That's what we're going to expect when the market's been hammered this hard. But Home Depot, when it's all said and done, to break out into new highs, high probability. JD, this one set a new high yesterday. One of the very few stocks on the challenge watch list to set new highs. Set a new high yesterday. This is one where when things settle out, the path of least resistance is going to be higher. Coca-Cola. Coca-Cola had the dip. Right, here we go. The dip. And the rip brought it right back up to where the dip started. And it's pulled back since, but has that AT&T style action here on it. Netflix. Netflix had the dip. Several times has completely recovered the dip. It's a very different style chart. And this is one we talked about as, things started to go ski-wumpus with the market. We talked, hey, Netflix is holding up really well. Doesn't mean I can just go buy it willy-nilly, because in these types of corrections, we tend to get the best stocks. They eventually get taken out. But Netflix has held up extremely well. Naturally, it hasn't, it hasn't hit new highs the last 2 days with the market falling as much as it has. But it has shown us something here this week, and that is that the chances of new highs on Netflix going forward when the market calms are very high. Procter and Gamble. This looks like Coca-Cola, like AT&T, right? Comes right on back. And then last but not least here on the challenge watch list, Walmart, which has taken the dip, has come all the way back. And so as far as stocks, though, you can look and you can say the probability is significantly greater that these stocks hit new highs versus others. These are those: AT&T, Home Depot, JD, Coca-Cola, Netflix, Procter & Gamble, and Walmart. Will the Apples of the world hit new highs? Yeah, they're better chance than an American Airlines, right? Better chance than an American, but it may take a little bit more time in order to pan out. What about an American Airlines? It's not going to hit a new high anytime soon. In fact, the market will be setting new highs multiple times before an American Airlines will hit new highs. So when you're approaching an American Airlines or when you're approaching a Bank of America, you have to approach it with a little bit of a different mentality. And that is not of, hey, investors are going to be piling in aggressively, more of a mentality of, okay, how can I play the bounces? Which is a lot more difficult, a lot more challenging than playing the more invested trends there with it, and in many cases a little more news driven than technically driven overall. But hopefully that helps in terms of, kind of taking some of this week's action, which stocks are starting to show something different in terms of price action. We could break these stocks down fundamentally, but I don't think that has much value right now. Fundamentals in the market right now don't matter all that much, as the fear factor is greater than the fundamentals. And that's what we almost always see when there are pullbacks to this magnitude out there in the market. Okay. All right. Should something change, and should we get a challenge signal that's tradable here this afternoon, which I believe is very low probability looking at the option pricing. But should it happen, I'll jump back on video. I'll make the trade. We'll go with it. But if we don't get that, I'm not going to jump back on video here this afternoon. And so have yourselves a fantastic weekend. And thanks for being with us here at Trader Minute. And we'll talk to you again on Monday. Take care.